markets. Look at precious metals. I think you've got a lull before the storm here in gold. A lot of the Wall Street traders are writing gold off. They're saying the rally is over because there's nothing to worry about. The crisis is over. That's not why gold was going up. Gold was never rising because of a crisis. It was rising because of money printing, inflation, cheap money. If you look at what was going on with gold from 2000 to 2008, gold was doing a lot better before the crisis than it did during the crisis. And the way they papered over the crisis is by printing money, destroying the value of currency. And so gold's going up, and so are stocks.
I have to disagree with the Armageddon forecast here. I mean, first of all, I think milestones absolutely do matter. And if you look, big round numbers play really well on Main Street. When you go to a bakery or barbershop this weekend, or in between the Super Bowl game, people are going to say, gee, did you see the market? And that gets individual investors re-engaged in the market. And I think that's entirely rational behavior. Look, let's call it for what it is. It's a momentum-driven market. It's driven by fund flows and not necessarily fundamentals. But that doesn't preclude Armageddon necessarily. You've got this worldwide currency issue. There's a lot of scary stuff in the world.
Well, I bet more people are going to be talking about rising gas prices than rising stock prices.
Look, they've been talking about rising gas prices, and there's no question that dollars are concerned. You know what they're more worried about? They're more worried about higher chicken wing prices for the Super Bowl. That's what they're worried about. But now that conversation is going to shift back to the stock market because people want to make money. In 13 years, the market's done nothing. The bubble's gone.
Well, they're not making money in stocks, but they're going to lose a lot less in stocks than they will in cash or treasuries. That's for sure. When you have inflation, you run on real things. But don't mistake this for economic growth. The U.S. economy is in a lot of trouble. And the rising stock market doesn't reflect improving fundamentals. It reflects inflation and a debased currency.
Yeah. I look, never bet on the end of the world because it only happens once, right? You hear that repeatedly.
Why do you keep saying the end of the world?
And I think that argument is very limited.
Who's talking the end of the world?
Rick Santelli, can you get in here? I mean, Peter Schiff and you seem to have different opinions,
I think everybody's a little bit right, Judge. Everybody's a little bit right. All the major central banks of the old developed economies, even some of the just recently developed economies, well, they have central banks that have pretty much put a boundary around rational investors. As much as many of them like gold, they want some diversification. Where are you going to go? The treasuries are safe if you're really rich, if you're looking to accumulate wealth, and Peter's right, but it's still a mug's game no matter how you slice it. I agree with the guest that said the economy's sideways on fundamentals, but all roads lead to stocks. So whether you can come up with a quantitative argument or not, I would be crazy to challenge the direction of stocks. As far as interest rates, they're not fully buying into this. They're going to creep up a bit, but the bubble that everybody's right about probably isn't going to burst for years, and the Fed isn't going to voluntarily stop, in my opinion. So I don't think you have to worry about that with your stock trade in the here and now.
No, I totally agree. And look, Tom, I'm the first person to say this rally is 100% due to the Federal Reserve and the free money and the fact that there are very few alternatives. But let's not forget, I mean, we got a jobs number out today that was better than expected, or at least it was in line with expectations and the revisions were better than expected. We got a housing market that has clearly turned the corner. And we have a corporate sector that is flush with cash, $3.6 trillion. So while, yes, I agree the economy is not showing any great shakes, we are seeing pockets of this story actually show real vibrancy.
So this is a long conversation. I'll try to keep it really short. I think all the things that you've just described fit very snugly into an economy that's moving along at a 2% rate.
Which is what we are.
Which is exactly where we are. So again, there's no momentum being generated. And at the end of the day, I think if you're stagnant, that has to work into your fundamentals. So the job report is a great example. With the background revisions,
you've got to buy the government's inflation numbers, though, if you think the economy is actually expanding. And by the way, $85 billion a month in QE isn't going to be enough to stop the bond bubble from bursting.
But Maria makes a good point, though. There is a little bit of momentum.
They're going to have to step it up. They might have to raise 125,
there is real momentum, right?
And that's a lot of money getting
Peter, listen 1 second. Maria is right. I mean, there is real momentum, whether it is with housing, whether it is with manufacturing, whether it is with construction, whether it is with consumer spending, business investment. All of these little pockets have to mean something.
No, but again, define for me momentum.
They do.
As a great example,
Zero GDP in the fourth quarter.
Housing was a detractor from growth up until this year. This was the first year that housing contributed to growth. Contributed about 0.2 percentage points to growth. Housing again this year will be a contributor to growth. It'll contribute probably about 3 or 4 tenths of a percentage points. So is going going from 0.2 to 0.4 momentum? Absolutely. But what's the degree of momentum?
If there's momentum, what is driving it? Where is it coming from? It's coming from a printing press.
That's the compelling
it's cheap
part
money.
of the story.
What do you expect?
Yeah, you know what,
well,
Maria, I would argue here that this is
that we should be having.
Right.
We do not have the kind of job growth, the kind of economic growth that one would expect at this point in the recovery.
That's critical.
That's absolutely
and we're never going to get the job growth as long as the Fed is stimulating, as long as the government is spending and regulating. The economy is never going to grow. All we're going to do is print money to base our currency.
Maria, I would argue here, though, that
that's
also,
a good thing.
Peter, you need to check your ideology at the door in this environment and recognize that the Fed is way more, whether we like it or not, this is the world we live in and we've got to navigate it. No one asked me if I like the Fed's policy.
Right. No, let's make that the last word, too. Larry makes his point, right? It is what it is.
Well, you're living in the world. You should understand it. You might like it, but you got to understand it.
I don't disagree with that.
Gentlemen, thank you very much. Great conversation. We appreciate it.